What should you do if you have $300 to invest? Okay, that's a good question. The answer I'm going to give you is not going to be one that you're going to hear from the popular investment media. A lot of people would say just put it into a savings account, or maybe buy a CD if that's possible, or a money market fund. Or if you have somebody that's particularly adventurous, they'll say put it in a good stock index fund. I don't think there's anything really necessarily wrong with investing in a stock index fund, but all you're going to really get is average, and you're really not going to learn anything. If you're just trying to get started and you have $300, you want to put it somewhere, my suggestion to you is a good dividend reinvestment plan with an individual stock. A lot of companies have what are called dividend reinvestment plans. What are those? Basically, this is a company that pays a dividend to you every quarter, say. Let's say it's a $30 stock and it pays you $1 every quarter. With a dividend reinvestment plan, that company will reinvest that dollar for you into its own stock. Every time that you come up to a new dividend payment, you have more shares on which that's paid. And this is really a great way to compound wealth. I guess that's the best way to think about it. So that's number one reason why this is a really good thing. The other reason is that you're going to be focused on a stock, and you're going to be able to see what makes that stock move, what sort of things that happen in the economy, or what sort of news or company results. And so I've spent a lot of time as a professional looking at individual company results. How are their earnings stacking up? And one big reason I do that is because it tells me how safe is that dividend, and is that dividend that they're paying going to be increased over time? Dividend reinvestment plans really get you involved in all that. And I'll let you in on a secret. This is actually the first kind of investing that I started to do when I got started investing in my 20s in stocks. And I did it in companies that I had a very strong degree of confidence would be around in 20, 30, 40 years whenever I wanted to cash those things out. So I looked at things like big oil companies. No big surprise. You look at a company like ExxonMobil or Chevron, and you look at their balance sheet, it's stronger than most sovereign nations. Oil is maybe not popular in some circles these days, but it is the lifeblood of the world economy. Almost everything runs off of it. So companies that dominate it, like those big oil companies, tend to weather almost anything out there. And at any kind of recession or market crash, they're going to make it through. Not every company can say that, but they have a very excellent long-term record in terms of gradually increasing value over time. So I've had a dividend reinvestment plan in Chevron. I actually got it started not with $300, but with $1,000 I put in there. And this was actually back when there was a company called Texaco. That's the company I actually bought, and Chevron merged with them. So my shares of Texaco became shares of Chevron. And over time, Chevron has continued to get stronger and stronger, increase its dividend, but I've reinvested that dividend. I haven't taken it as a cash payment. I've reinvested it in stocks through their dividend reinvestment plan. And over time, that thing has basically grown about a 20-to-1 off my initial investment. So pretty fantastic return. And I've done that with a half a dozen other companies. Some of them are utilities, some of them are oil companies, but the common thread is that they're very steady companies, growing over time and growing their dividends over time. Basically, my wealth has expanded by the fact that I've reinvested the dividends, gotten more shares. The dividends have been increased, so each time I've been investing more money, and then also I've gotten appreciation out of that stock. So a triple threat, and again, I think that's very important, certainly. And it's been a no-brainer. I've just been continuing to reinvest, and often I don't even think about it, but my money's going to work for me. And another advantage of dividend reinvestment, that your dividend is going to be able to buy more shares of that stock when the stock price comes down. You actually cheer for the stock to be down a little bit around the time they pay the dividend, and that increases your wealth as well. Dividend reinvestment has kept me engaged. I've learned what makes stocks move and so on. It's increased my wealth. And these are, again, the most important things you want to do in your 20s. You're learning to invest. The bulk of your earning years are in the future, almost certainly, unless you're a professional athlete, perhaps, or an actor. But for most of us, our income's coming along later. And learning how to make money in the stock market, I think that's the most important thing you can do investing today. You're not going to learn how to invest in the stock market if, say, you buy a target fund or an S&P index fund. And the other thing about these index funds and these ETFs, exchange traded funds, is that they're put together so you own all of a sector. You have a diversified portfolio in a sector, but you don't just own the good companies, you own the bad and the ugly companies as well. Again, learning how to pick stocks, I think, is very important. And that's my suggestion for you as an investor trying to invest $300. Look to one of these dividend reinvestment plans. Look to a utility, look to a big oil company. Those are probably your safest bets. But there's a lot of other companies out there as well, and you can find out what they are by just simply doing a Google search. There'll be a nice list of companies, and I would just advise looking for some of the larger ones, the companies that you might recognize the names of as a customer of or by what they do. Certainly all of us, anybody that has a car is a customer of the big oil companies. Even if you buy an object that's, something that's packaged in plastic, you're a customer of big oil companies. So that type of thing, I think, is very important. There are a number of companies out there, big tech companies, that don't pay that much in dividends. So the dividend is going to be a part of it. And I would suggest looking for something that yields the dividend. And the dividend yield is basically a percentage return. So you calculate it by just taking the dividend and dividing by the price of the stock that you pay. So it's a percentage return. And yield it's called a yield, and you can see it published in all sorts of any financial data, whether you're using Google Finance or Yahoo Finance or just looking things up in the paper. You're going to see a yield. So I would look for a yield that is at least 3%, preferably 4%. If you can dividend reinvest in something that's safe and big and has a yield of 6%, so much the better. Your money's going to compound faster, and you're going to wind up doing a lot better for that. Again, go out there, find a dividend reinvestment plan in a company that you think highly of, perhaps. That certainly helps. And one that has some weight behind it, and one that has a nice yield. And then get involved with their dividend reinvestment plan. Now, again, you can search out dividend reinvestment plans just with a Google search. If you decide, hey, I want to buy, I've mentioned its name several times here, Chevron, for example. I want to buy Chevron. I want to get in their dividend reinvestment plan. Just do a Google search for it, and that'll give you the contact information. Boom, you're done. Send them your check, sign up for the fund, and watch your money grow. Thanks for listening.